Welcome back to Griffonomics. Today we are dissecting a company that I can only describe as uh, a glitch in the matrix of modern capitalism. We're looking at a manufacturing business, people who bend metal and forge parts, that operates with profit margins you'd expect to see in, like, the software world.
It really is an anomaly. If you showed a standard economist the financial statements of TransDigm Group without the name at the top, they would guess it was a tech monopoly. They certainly wouldn't guess it was a company making, valves and latches.
We're talking about TransDigm, ticker symbol TDG. And just to set the scene, today is Tuesday, February 3rd, 2026. This morning, TransDigm dropped their Q1 earnings report, and they also pulled back the curtain on a massive, what was it, a $3.16 billion spending spree.
Which is a huge pivot.
Yeah.
They've been in harvest mode for a little while, and now suddenly they're back to hunting. But the immediate reaction from the market is the real puzzle we need to solve. They posted double-digit growth, maintained margins north of 52%, and yet the stock is down about 3.6% today.
That's the tension right there. You print money, you grow, and the market just shrugs.
Yeah.
So, our mission today is to figure out why. We're going to tear apart this Q1 report, scrutinize these new acquisitions, and we need to understand if the TransDigm machine is finally, running out of steam. But before the numbers, we have to talk about what this company actually is, because calling them an aerospace supplier completely misses the point.
It does. To understand TransDigm, you have to stop thinking of them as a manufacturer. You need to see them as what they are, a private equity firm disguised as a public company.
Okay, that's a catchy phrase, private equity in disguise, but let's push on that. What does that actually mean for how they operate?
It all goes back to the founders, who are former McKinsey consultants. In a normal company, the CEO might want to build the coolest, most innovative product. TransDigm doesn't care about cool. They care about proprietary. Their entire strategy is to buy businesses that are the sole source supplier for a specific part.
Sole source, so a monopoly.
For that one part, yes, roughly 90% of their revenue comes from products where they are the only game in town.
But hold on, we're talking about airplanes. If I'm Boeing or an airline like United and TransDigm charges me a fortune for some part, why don't I just go to a competitor?
You can't, and this is the beauty of their moat. It's not about the metal, it's about the paperwork. To put any part on a commercial aircraft, it needs FAA or ES certification. That process is incredibly expensive and time-consuming. Once a part is certified for an airframe, it is locked in for the life of that plane, maybe 20, 30 years.
So the government regulation is the lock on the customer's wallet.
The regulation is the product. The metal is just how they deliver it. And this enables their famous razor and blade model. They sell the original part to the OEM, the airplane manufacturer, often at break even. That's the razor. But they make all their money on the aftermarket replacement parts, the blades, for the next 3 decades.
And since a grounded plane costs an airline hundreds of thousands a day,
the demand becomes completely inelastic. Whether the part costs $500 or $5,000, the airline has to pay it. That pricing power is how they get to an EBITDA margin of 52.4%. You just don't see that in the industrial sector.
it sounds incredibly profitable, but also, ruthless. How do they maintain that discipline across such a massive company?
It's the other part of the private equity model. They are radically decentralized. TransDigm is really just a holding company for dozens of small autonomous units. Each one has its own P&L, its own president. But here's the kicker, the compensation.
Right, I read about this. It's not just a standard bonus.
Not at all. It's much more aggressive. The top executives have a huge chunk of their pay tied to stock options. But, and this is the key, those options only vest if the company hits very strict annual return targets, usually between 10 and 17.5%.
So if the company grows at 9%, which for most manufacturers is a great year, these guys get nothing.
Zero. Their options are worthless. This turns every single manager into a ruthlessly efficient capitalist. They're focused on this quarter, this year. How do I get my return to 17.5%? And the answer is usually raising prices or cutting costs.
Which explains the 52% margins. Okay, so that's the machine. It's designed to print cash, but let's go to this morning. Q1 earnings. Revenue up nearly 14%, EBITDA up almost 13%. The machine is working. So why did Wall Street punish the stock?
It's the curse of high expectations. TransDigm trades at a premium, around 25 times earnings. When you're priced for perfection, just being good isn't good enough. The headline numbers beat official estimates, but they missed the whisper numbers.
The whisper numbers, the secret bar that everyone actually expects you to clear.
That's just the reality of it.
Yeah.
But there was also a structural issue in the report, something called the mix shift, We talked about the razor and the blade. The blade, the commercial aftermarket, that's where the real profit is. In Q1, the aftermarket only grew 7%.
7%. I mean, that's not terrible, is it?
It's not, but it lagged the rest of the market recovery. And more importantly, the OEM side, the low-margin razor, grew at 17%. So they're selling a lot more of the cheap original parts and not as many of the high-profit replacement parts as investors wanted.
I see. So the revenue number looks big, but the quality of that revenue was a little diluted. Why is the aftermarket lagging? People are flying again.
They are, but the supply chain is a mess. Management pointed to something called distributor destocking.
Okay, break that down for us. What is that?
Think of distributors as the middlemen. After all the COVID chaos, they bought up tons of TransDigm parts to make sure they had inventory. Now their shelves are full. So even though airlines are buying from the distributors aren't placing new orders with TransDigm. They're just burning down their existing stash.
So it's like a snake digesting a meal. The lump has to move through the system.
That's the argument for management. They say it's temporary. CEO Mike Lisman called the recovery bumpy and uneven. He also pointed a finger at Boeing and Airbus supply chain issues.
Right. So a slight slowdown, a nervous market. If you're TransDigm and you can't squeeze more profit out organically, what do?
You go shopping, you buy growth. And that brings us to the $3.16 billion spending spree.
This is the strategic inflection point. They've been quiet, paying down debt, and then boom, 2 huge deals. Let's start with Stellant Systems. $960 million. What is it?
Stellant is a classic defense play. They make mission-critical electronics for things like radar systems, electronic warfare, satellite communications.
They're just definitely not toilet valves. This is high-tech stuff.
High complexity, which fits the moat. But here's the private equity angle that I found interesting. One analyst team figured out that Stellant's sales per employee are roughly half of TransDigm's current average.
Half. Okay, so does that mean Stellant is inefficient or just that TransDigm is incredibly lean?
It means TransDigm sees a massive opportunity. When a private equity firm sees low sales per employee, they just hear bloated headcount.
So they're going to go in and cut.
They are going to optimize. They'll strip out corporate overhead, probably raise prices, and work to get Stellant's margins up to that 50% standard. It's their playbook.
Okay, but that's the smaller deal. The big bet, $2.2 billion, is on Jet Parts Engineering and Victor Sierra Aviation. And this is where it gets interesting because these companies specialize in PMA.
Parts manufacturer approval. Yes, this is the most controversial part of the whole announcement.
Right. So TransDigm is usually the sole source OEM. They own the patent, the certification. PMA is basically the generic drug of the aerospace world. Another company gets FAA approval to reverse engineer a part and sell it cheaper. OEMs hate these guys.
They see it as a parasite on their business model. It threatens that pricing power.
So why on earth is TransDigm spending $2 billion to buy the parasites? Is this a catch-and-kill operation, buying them just to shut them down?
That was the first question on everyone's mind. And on the earnings call, CEO Mike Lisman was adamant. He said, no. He claims they are not going to integrate them. They will let them run autonomously.
I have to be skeptical. You buy your cheaper competitor and you just let them keep competing. That doesn't sound like the TransDigm we've been describing.
Look at the math. Lisman says they see a path to a 20% internal rate of return on the deal. That's their magic number. They believe the market for these so-called generic parts is growing, and they just want a piece of it.
But isn't there a conflict of interest? If I'm an airline, I can buy the $5,000 TransDigm valve or the $3,000 TransDigm-owned generic valve. TransDigm gets my money either way.
That's the ultimate hedge, isn't it? It's kind of brilliant. If the industry shifts toward PMA parts to save money, TransDigm wins. If the industry stays loyal to OEM, they win.
So they're betting against themselves, so they can't lose.
In a way. And frankly, they needed a deal this big. It's the law of large numbers. TransDigm's a $73 billion company. Buying a tiny $50 million shop doesn't move the needle anymore. They have to write billion-dollar checks to keep the growth story alive.
It feeds the beast. Speaking of which, we have to talk about how they pay for all this. This company is loaded with debt.
They are. Net debt is currently $27.7 billion.
And the leverage ratio
stands at 5.7 times net debt to EBITDA.
Okay, let's pause there. 5.7x leverage. In most industries, red lights are flashing, sirens are going off. Why does the market let TransDigm get away with this?
Because for them, debt isn't a bug, it's a feature. They see debt as a tool to amplify equity returns. If you can borrow money at 6% and invest it in a business that yields 20%, You're creating huge value.
But it's 2026. Rates aren't zero anymore. That debt pile has to be expensive.
It is, but they've built a fortress around it. The CFO pointed out that about 75% of their gross debt is fixed rate or hedged through 2029. So even if rates stay high, their interest payments are pretty much locked in.
So they have a shield for a few more years.
And look at the cash they generate. In this quarter alone, over $830 million in operating cash flow. They could easily pay the bank and still have money left over.
But surely with $27 billion in the hole, paying it down should be a priority.
You'd think so, but no. It's actually their lowest priority. Their capital allocation plan is explicit. Number 1, reinvest. Number 2, M&A. Number 3, return cash to shareholders. Paying down debt is a distant fourth.
That is just wild. They'd rather spend $2 billion on a competitor than pay off a single dollar of principal.
Because paying off debt reduces their leverage, which, in their model, reduces their return on equity. It's all part of the formula.
It works until it doesn't, I suppose. And that brings us to the risks. We've painted a picture of this perfect machine, but the stock dropped. What should people be worried about?
The first risk is just valuation. As we said, price for perfection. You have zero margin of safety at these multiples. If that aftermarket recovery drags on, or if destocking is actually a real slowdown, this stock could fall fast.
And then there's the government. The Department of Defense knows they're the sole source. They've been accused of price gouging before.
They call it excessive margins. And yes, TransDigm has been hauled in front of Congress. They've even had to refund about $40 million in the past just to make the problem go away.
But $40 million is a rounding error for them.
It is. And what they're doing isn't illegal. It's just very aggressive capitalism. But there's always the political risk that procurement laws could change, especially for their defense business.
Which is now a bigger piece of the company, thanks to Stellant.
Precisely.
Yeah.
And defense bookings are notoriously lumpy and unpredictable quarter to quarter.
So, bringing it all together, a company that defies manufacturing gravity, a new $3 billion plan to conquer both the high-end and low-end markets. Is this a buy?
The analyst consensus is that TransDigm is still a high-quality compounder. The moat is real. The management team is excellent at allocating capital. But given the valuation and the current sluggishness, it feels more like a hold.
A hold for now. Maybe wait for a dip.
If you're a long-term believer, you stick with it. But you don't need to chase it today.
Before we go, I want to leave our listeners with one last thought on that PMA deal buying, the generic competitor.
The hedge.
It feels like more than a hedge. It feels like the end game. If you own the problem, the aging plane that needs parts, and you own the only two solutions, the premium brand and the discount generic, have you effectively gamified supply and demand?
You've certainly removed the element of choice for the customer.
It just makes you ask, is there any way for a customer to win here? Or is the entire supply chain just a machine for transferring wealth from airlines to TransDigm shareholders?
As long as the planes keep flying, someone has to pay the toll.
A comforting thought for your next flight. Thanks for diving deep with us on Griffonomics.
Thanks for listening.